Hello everyone, and welcome back to the Web3 Daily, where today, the market is basically on a rocket ship. Bitcoin just floored it, smashing right through the $125,000 ceiling to hit a new all-time high. Honestly, when I saw that price, my palms started sweating a little. The overall market sentiment is just euphoric. We're looking at a total market cap over $4.1 trillion, with a 24-hour trading volume north of 340 billion, and Ethereum is sticking right behind the big guy, holding strong, about $4,600. You can clearly see Wall Street's fingerprints all over this rally. The ETF money is just pouring in like there's no tomorrow. But what's interesting is that Bitcoin's dominance has slipped just a tiny bit. What does that tell us? It means some of that capital is starting to spill over into altcoins. Could this be the start of alt season? That's something we need to keep a close eye on. Of course, with this kind of volatility, always remember to manage your risk, alright? Let's get into some drama today. And this one's about a project that was once the talk of the town, but is now facing rug pull accusations. I'm talking about the SocialFi project, friend.tech. Recently, the team suddenly announced they've permanently given up control of the project's smart contracts by setting the ownership parameters to Ethereum's null address. Basically, they threw away the keys, meaning no one can ever change the fees or functions again. This move immediately sent the community into an uproar, with many screaming rug pull. And those accusations aren't coming out of nowhere. On-chain data shows that between last December and this June, the friend.tech team cashed out nearly 20,000 ETH, worth over $52 million. At the same time, their friend token, it's down 95% since it launched. So you have the team cashing out big time on one side, and the token price hitting rock bottom on the other. Plus this bizarre move to abandon control. It's no wonder the community is calling it a Ponzi. Of course, the project team denies it's a rug pull. They came out with a statement saying this move was to guarantee that no new fees could ever be added, and that the app's functionality is completely unaffected business as usual. But what's really wild is that, right in the middle of all this controversy, they also announced they're migrating off the base chain to build their very own blockchain called Friend Chain. So you've got this crazy situation. On one side, the team is cashing out and locking the contracts. On the other, they're claiming they're building a whole new chain to keep the project going. Are they just pulling a fast one? Or are they actually playing 4D chess? Is this former social media darling dead in the water? Or can this new chain bring it back to life? This is one story we'll definitely be keeping an eye on. Okay, moving on from our main topic, let's get into our first major news story of the day. And this one is an absolute bombshell for Wall Street. The financial giant Morgan Stanley, one of the oldest names in the game, has finally caved. Their global investment committee has officially put out guidance recommending that clients start adding crypto assets to their investment portfolios. You heard that right. It's in black and white, official advice. The document is specific. If you have an opportunistic growth portfolio, you can allocate up to 4%. If you're in a balanced growth portfolio, you can go up to 2%. Their reasoning. They're calling Bitcoin a scarce, digitally native asset that's gaining so much institutional relevance. It can now play a unique role in a diversified portfolio. But here's the real game changer in all of this. For years, if a financial advisor at a big bank even whispered the word Bitcoin to a client, they were risking their career. Any recommendation for crypto was seen as reckless speculation. Not anymore. Morgan Stanley's global committee has just given them institutional air cover. This means that the most conservative, high-net-worth individuals who were previously locked out due to compliance and career risks now have a legitimate pathway to enter the market. We're not talking about retail FOMO. This is stable, large-scale, long-term capital. And you can bet that the folks at Goldman Sachs and JP Morgan are in emergency meetings right now. If they don't follow suit, they risk losing clients. So this isn't just a news headline. It's the first domino to fall. It's going to force all of Wall Street to take crypto from the alternative investment fringe and give it a permanent seat at the main portfolio table. Next up is a piece of news that's absolutely nuclear for the stablecoin industry. Over in the US, a bill called the Genius Act has officially been signed into law. You might think, just another piece of legislation, right? No, this is a huge deal. It's basically the first ever national regulatory framework for stablecoins in the United States, giving them an official ID card, so to speak. There are a few key points in this act you need to know. First, it mandates that stablecoin issuers must hold one-to-one reserves in high-quality liquid assets like cash or short-term T-bills. This puts a real backstop behind the stable in stablecoin. Second, it creates a dual-track system. Large issuers with over $10 billion in circulation will be federally regulated, while smaller ones can operate at the state level. as long as their standards are similar to the federal ones. But the most crucial part is this. The act explicitly states that compliant payment stablecoins are times not times securities and times not times commodities. That single sentence effectively kicks the SEC and the CFTC, two agencies that have been causing a lot of trouble, out of the picture. And one more thing, it prohibits issuers from paying interest to stablecoin holders. So, what does all this really mean? Let me tell you. This act is the golden key that unlocks corporate treasuries. Before this, what public company CFO would dare put stablecoins on their balance sheet? The regulatory uncertainty was just too high. Now, with a clear legal status, reserve standards, and a designated regulator, that risk is gone. Corporations can now legitimately use compliant stablecoins, like USDC, as a highly efficient tool for B2B transactions, cross-border payments, and even payroll. You can just imagine the massive demand that's about to be unleashed, and that no interest clause. It might seem like a limitation, but it's actually forcing the industry to evolve. The old game was the yield wars, competing over who could offer the highest returns. That's over. The new competition will be all about payment utility. Who has the fastest, cheapest, and best integrated network will win. This is what stablecoins were always meant to be, the future infrastructure of finance. And now for some news on product innovation that could completely change the crypto ETF game. Grayscale, the world's largest digital asset manager, just announced that some of its spot crypto ETPs listed in the US will now support staking. Specifically, their Ethereum Trust ETF and Solana Trust will now not only let you profit from price movements but also earn yield while you hold. Grayscale will stake the assets held in the funds, and the rewards will be added directly to the fund's net asset value, all while being tax efficient. On the surface, this might just sound like a little extra yield, but if you think about it, this is a game changer. It creates a product that is structurally superior to non-yielding assets like Bitcoin ETFs or gold. I mean, imagine you're choosing between two identical Ethereum ETFs. One only gives you price exposure, while the other gives you that same exposure, plus an extra 2% or so in annual yield. Which one would you pick? Any rational investor would choose the latter. So, with this move, Grayscale has set a new standard for all POS asset ETFs. From now on, any firm launching an Ethereum or Solana ETF without a staking feature is going to look completely out of touch. Giants like BlackRock and Fidelity will likely have to scramble to catch up. More importantly, this creates a powerful growth flywheel for POS networks like Ethereum and Solana. The more traditional capital these ETPs attract, the more tokens get staked, making the network more secure and reducing the circulating supply, which is inherently bullish for the price. A more secure network with a potentially higher price, in turn, makes holding the ETP even more attractive, creating a perfect positive feedback loop. So, Grayscale's ETP is no longer just a passive price tracker, it's now an active participant in building the ecosystem it invests in. Now let's talk about the star of the show today, Bitcoin, $125,000. Just saying that number feels powerful. Bitcoin didn't just break through, it planted its flag and set a new all-time high. This rally isn't being driven by just one thing, there are two massive forces at play. The first, as we've discussed, is the ETFs. These Wall Street behemoths are just insatiable. Last week alone, they vacuumed up another $3.2 billion. They're like a giant vacuum cleaner, just sucking up all the available supply. The second force is a bit more interesting. It's called the debasement trade. To put it simply, people are losing faith in the US dollar. You see the US government shutdown, drama, the geopolitical instability, the cash in your pocket is feeling less and less valuable. So what do? You buy hard assets, and Bitcoin and gold are at the top of that list. The on-chain data backs this up perfectly. The amount of Bitcoin sitting on exchanges has dropped to a 6-year low. What does that mean? It means people are pulling their coins into cold storage, locking them up, and refusing to sell. You've got insane demand on one side and a supply squeeze on the other. How could the price times naught times skyrocket? This is why this bull run is different. Bitcoin is no longer just a risk-on asset. It's playing both offense and defense, acting as both a spear and a shield. And that's what makes it so powerful right now. Alright, let's shift gears from the macro and regulatory world and dive into the dog-eat-dog battles happening within DeFi itself. The king of decentralized exchanges, Uniswap, just made a power move. The development company behind it, Uniswap Labs, went out and acquired a crypto research firm called Guidestar. The goal here is crystal clear. They want to dominate the core tech of automated market makers, or AMMs, and smart order routing. In plain English, they want to make damn sure that when you trade on Uniswap, you're getting the best possible price on the entire internet. When I saw this news, my first reaction was, okay, the DEX wars have officially entered a new phase. What was the old game about? It was all about TVL, about liquidity depths. Whoever had the deepest pools had the lowest slippage, and they were the top dog. But now, just having a ton of liquidity isn't enough. With all these trade aggregators and MEV bots running around, the new core competition is about how to find the absolute optimal trading path for the user in this incredibly complex environment. So, this acquisition is Uniswap's pivot from the liquidity wars to the execution quality wars. They're investing in the future, trying to lock in the whales and high-frequency traders who generate the real fee revenue. And what's more, it shows that Uniswap is starting to play like a mature tech giant. They're using their dominant market position and their war chest to absorb smaller, innovative teams. This does two things. It makes them stronger, and it takes a potential future competitor off the board. It's a protocol black hole strategy, sucking all the smartest people in the space to build an even deeper moat around your castle. For our final story, let's look at the exchange giant, Coinbase. They just made a huge move, officially applying to the US Office of the Comptroller of the Currency, or OCC, for a National Trust Company charter. This isn't just some minor paperwork. This is a strategic play to bring their core business under unified federal regulation. Coinbase themselves said the goal is to expand their payments and custody operations and to streamline the process for launching new products in the future. And they made a point to emphasize, we have no intention of becoming a bank. Now, that last sentence is the key. On the surface, getting this charter means Coinbase no longer has to deal with the patchwork of regulations across all 50 states, which dramatically cuts down their compliance costs. But if you dig deeper, this reveals two major ambitions. First, they want to become the crypto prime brokerage of the world on Wall Street. Prime brokerage is a core service for top-tier hedge funds, covering everything from asset custody to trading and financing. And the absolute foundation of all those services is regulated custody. This national trust charter is the gold standard for asset custody. Having it is the only way to attract the most conservative, deep-pocketed clients like pension funds and sovereign wealth funds. Their second ambition is a very clever bank function inversion strategy. By repeatedly saying they don't want to be a bank, they're essentially cherry-picking the most profitable and strategically valuable parts of banking like custody and payments, while skillfully avoiding the heavy capital requirements and the regulatory burdens that come with being a full-fledged bank. This allows them to both integrate deeply with the traditional banking system and compete with it in areas like payments, all without carrying the legacy baggage of a traditional bank. It's a brilliant move. Alright, that wraps up our Web3 daily report for today. If you found this helpful, be sure to hit that like button to show your support. Every day, we're here, sorting through the noise to bring you the most critical information in the Web3 world, the news that's closest to where the money is moving. We hope that by breaking down these hand-picked stories, we can help you make more rational and informed decisions on your Web3 investment journey. Also, I've dropped some exclusive registration links for major exchanges down in the comments section for you all. These are special high rebate deals we've secured for our community, and we hope they can help you save on some costs as you invest. Let's all stay rational, move forward steadily, and get rich slowly together in the world of Web3. May all of your crypto assets see steady growth. We'll see you tomorrow.